Welcome to the Burgess Rawson from CBRE Podcast. And today we're talking all things results from Portfolio 178. Welcome Darren Beehag and Geoff Sinclair.
Thanks, Ingrid.
Thank you.
Morning.
It was an incredible portfolio last month, considering we had not yet had the interest rate cut, and there was conjecture as to whether or not we were even going to get one. But it was a portfolio of childcare that we saw coming through last month. Geoff, talk to me about these Good Start Early Learnings. What drove those incredible prices?
Yeah, some phenomenal Queensland Good Start childcare investments sold last campaign. Beautiful Queensland locations, high underlying land value, freehold, of course. All leased at Good Start Early Learning, all on incredible leads. They were all triple net leases as well, so tenants are responsible for all of your outgoings, including land tax and structural repairs and maintenance. So it's a pure set and forget for investors. Investors love childcare. Triple net lease childcare is just very, very sought after and very rare as well.
And we sold some 11 childcares, but they varied greatly in price. There was still something for everyone in relation to, yield, type of tenant, and location. But most of them were sitting in Queensland. What is the love affair with Queensland, Darren?
Yeah, there's been a real focus on Queensland. I don't think it is an accident that some of those tight yields, looking at the childcare yields, 3.89%, 3.91%, up to about 4.5% they were the top 5 assets in the portfolio, all childcare. One in New South Wales in Marylands, which is a great metro position. But I think investors see Queensland as a growth state. The Olympics coming up, of course, so there's that angle as well. But I think those yields tell us that investors know what they're looking for. And as Geoff said, long leases, triple net leases, great rent review structures, good land areas and good metro positions. So a lot of those assets really ticked every box.
And it's a theme we've actually seen in 177 and 178. In 177, we saw record yield for fuel, which is something that we hadn't seen in a very long time. But it again talked to underlying land value, quality, and tenure. So I think that what we're seeing is there's been a lower levels of stock, but there's still some incredibly sharp yields driven by this quality factor. So I suppose premium always sells, doesn't it?
Certainly does. Any market, they're always saleable, and investors know what is good, don't they? They know the difference, and that was evident in those yields last week.
And it talks to liquidity in the commercial property market, which I think there's a perception or an expectation that property in its first place is not liquid, but then secondly that commercial property is even less liquid than say residential property. Whereas these properties are coming to market, it's a 4-week campaign. And there's transparency and outcomes for owners at the end of that period. So it does talk to, where you're buying premium and continue to buy premium, that there is always liquidity for investors as well.
Absolutely. And they're buying under auction conditions. They can see the competition in the room. That, after all, is their exit strategy later on. Those investors who have missed out could be their buyers in 3, 5, 10 years' time. So they know that these properties are popular and goes back to liquidity, as you say.
And Geoff, there was a few medical properties. I know that in auction 179, the theme is medical, and you are going to be the outstanding medical expert by the end of auction 179. But what I found interesting, when we're quoting prices, people often say, "Oh, are you really buying regional for 7%? Are you buying regional in 5 to 6?" But Portfolio 178 actually established a lot of that pricing, and we had Innisvale and we also had Campbelltown. Campbelltown being metro, selling in the 5.8, and then we had Innisvale being regional at the 7.16. So that does somewhat support pricing. The medical portfolio you've got coming up, what kind of price point is that?
Assets ranging from probably mid threes up to mid 20s. I guess really.
$1 million.
Yeah.
Yep. So and what yield?
Yields between 5 and 6.5, I'd say, depending on metro versus regional. Very similar to where these traded. That IMED in Campbelltown was a phenomenal entry. We call it entry level medical investment. Lower price point, below $1 million, which is quite rare, very attractive, and it had a phenomenal MRI room, which is obviously proves to be a very sticky tenant. And they're not going anywhere because the cost to get in there.
You know,
And that at 720,000 to get into Sydney, I mean, I'd be buying that over an apartment or anything else in Sydney, wouldn't you?
Yeah.
And you've still got your depreciation and you're getting 5.82% return. And then you got your interest rate cut. So thank you to the Michelle Bullock and the Reserve Bank.
yeah, in a high growth part of Sydney as well. That southwest region
Yeah,
is
that's right.
just going crazy development.
And talking about the rest of the portfolio, so we had properties all over Australia, including ACT, Tasmania, Victoria. We didn't have anything from WA this time. What was the property that stood out for you, Geoff, within the portfolio of 178?
I mean, I think it was those childcares that sold so sharp. I think in Good Start Early Learning, 3.89%. I do know there was a lot of upside as well for the investors, where the fact that rental was below market, which does happen in childcares. The rent has grown a lot. So
Talk to me about that in childcare. So how is the rent established in childcare?
It's a cost dollar value per place on how it's assessed. I believe these ones were below market, and I think the rates in Sydney now I think they're probably about double cost per place where they're at. So there's a lot of room. You can get your capital growth on your rent going up and your yields compressing and selling at a different point of time, which protects your liquidity, and then you get your capital growth there as well.
And per place rents, Darren, really do vary across Australia, don't they? I mean, the ones in New South Wales are very, very different to that of, say, Victoria. Where is this per place rent being driven from?
Well, in part, it's construction costs. So you're getting your rental growth in part because construction costs have been increasing. So to make these developments stack, the tenants need to pay the rent. Otherwise, they can't grow, they can't expand, they can't open new centres. So that's been a big part of the equation, construction costs, driving rents upward. So too in fast food and other sectors as well.
And I suppose with productivity being a key part of the government's concerns and focus at the moment, we know that from a childcare point of view, I think the government, I'm never not sure of the most accurate stats, but something like $3 for every dollar they spend on childcare, they get back in productivity by ensuring that people are going to work and adding to the economy. And so that underpins a future bipartisan support of the childcare sector.
Yeah, absolutely. Absolutely.
And Darren, what was the standout for you in last auction?
Yeah, there was a real sprinkling of assets, as we always have them. I'm just looking at banks, traditional retail and restaurants and gyms. We had a government asset in Mornington, which I thought was a great asset, sold for $5,705,000, yield of 5.22% in Mornington in Tasmania. Government lease, always popular with investors, and Tasmania, well and truly on the radar for investors as well.
For me, it was the pet stock in Traralgon. I'm still in love with large format. I think there's incredible value there, and the quality of the tenants is just exceptional. So the pet stock there for 2.3 million, entry level investment, and you're still getting, a 5+% return. So that would have been the standout for me. I still love large format centre. Can't help myself. Yeah. We have an incredible property portfolio in 179. There is something for everyone from price point, tenant and style of property. But the clear theme of this portfolio is all things medical. And Geoff, you are bringing an incredible portfolio to market. Tell me a little bit about the tenant.
Yeah, I think we have over 10 medical assets in this portfolio. 6 of them in New South Wales are backed by PRP Diagnostic Imaging. So PRP are a leading imaging provider with about 35 locations in New South Wales, metro and regional, and looking to expand. They're backed by IFM investors and UniSuper, and they have about $381 billion in assets under management in their ownership group. So we've got 2 of them in the select portfolio and 4 are going to auction, all different price points, all different lease terms, up to about 10 years, and good net leases as well.
Tell me about Select. So Select is our special portfolio, which is for a higher price point investor. It's EOI, so it gives people a bit more time to find out more about the portfolio. Tell me about Blacktown, Geoff.
Blacktown's a phenomenal asset. I went through the other day. It's probably one of the nicest medical centers I have ever inspected. It's right beside the Blacktown Private Hospital, which is an immaculate hospital. You've got Western Sydney University School of Medicine right there. So it is the Western Sydney Healthcare Precinct. It's a multi-level integrated healthcare facility. You've got PRP, who are about 70% of the income. basement parking for about 100 cars, supported by Panorama GP, which is a brand new general practice. Then you've got Blacktown Dermatology, which is a business goes back to about 1966, a lot of experience, and of course a small physio as well. So it returns about 990,000, and that'll be part of our select portfolio. It's premium. It's brand new as well, purpose built, 2024, I believe.
So huge depreciation.
Huge.
Talking about depreciation, Darren, I know a lot of these medical assets have incredible fit outs and I mean even reinforced flooring for the MRI machines and things like that. Are all of these assets that are bringing to market going to have strong depreciation for the investors?
Yeah, they certainly will, Ingrid. And I guess it's important to note the difference between the tenant fit out and the landlord fit out. So both sides of the ledger will be able to claim depreciation. The landlord will be able to claim items on the building and some of the fittings if they come under the lease under their ownership. So there are a lot of special things in medical, like medical grade flooring, for example, vinyl flooring, refrigeration. There are different things that, and the devil of the detail is in the lease and the sale contract, of course, when you purchase the asset. But depreciation is a very important thing to a lot of our investors because who doesn't want to reduce their tax? So it is an important point.
And talking about price point, Darren, I mean, what I'm seeing here, what kind of yields is the whole medical portfolio looking like it sits at? Because we had an interest rate cut last week, and then these yields seem somewhat softer than, say, a traditional fast food asset. Where's the price point sitting from a return to investors?
Yeah, you're right. First of all, there's a price point to suit all investors. Medical starts from as low as $700,000 up to $30-40 million. And everywhere in between. Yield spread for metro, capital city metro, you're generally sub 6%. You're somewhere between 5 and 6%. And for regional, you're generally between 6 and 7%. There's about 100-point spread, metro v regional.
And that's quite unique, Darren. If I think about, say, fast food, the spread between regional and metro might be 30 or 50 basis points. For it to be 100 basis points, that's actually a substantial amount. And yet there's demand all across Australia, regardless of regional or metro.
Yeah, that's right. It's non-discretionary. So it's relatively low risk.
And Geoff, incredible government support and government funding in this space as well. The government's just announced the new budget. I think it's $125 billion by 27-28 just on healthcare.
Exactly. And a lot of that's going to be attributed to bulk billing as well. So especially these centres in the regions, they're in all different areas, all different demographics, and a lot of the centres focus big on bulk billing. Some have a split model, but bulk billing is very beneficial to all users, of course, with Medicare. Subsidize the cost. They take all the cost off the back and you're not out of pocket like a private area.
And another thing I'm seeing here is that, I mean, I know other than Tuggerah, they're all freehold assets. Yep. They've all got car parking on site. Tell me what generally the PRP portfolio looks like. If I was to attend one of these properties or not attend it and still want to buy one, what do they look like when I turn up?
Yes, you walk in and, premium reception, waiting room, and then multiple immaculate different treatment, consulting, or obviously specialty rooms. All of these are PRP diagnostic imaging centers, so they're core radiology and imaging locations. So the fit-outs are very vast and expensive. There's MRI machines, nuclear medicine as well in various locations, and PET scans as well. So there's all different various rooms. They're busy centers. They're very busy locations. Most of them are right next to hospitals or hospital developments, kind of as a gateway site. So they're all in very strategic locations. And that's a core thing with medical, being in a healthcare vibrant location, whether it's next to a hospital or next to kind of social infrastructure, is very beneficial to that sector.
And I know for me, when I want to go get a diagnostic test, Parking is a huge one. Being able to actually pull up and go and get a blood test and these all have parking on site.
They all have parking. Most of them are freehold and they all have exclusive parking. There's also various street parking. Blacktown, for instance, has 100 basement car parks. Charlestown has 62 multi-level. Even Tuggerah, being strata, is still attractive. It's part of a larger center, and I think there's hundreds of parking spaces right out shared amongst the tenants, but parking is very key for these.
So generally located near a hospital within a medical precinct, adequate car parking. How long are the leases?
They're up to 10 years, but a lot of them have been there for pushing 20 in some locations. So a lot of medical operators will consistently renew 5 or 7 year lease terms up to 10, but the track record of their tenure is always quite long. For example, Wollongong was an original 18-year lease with about 3 years to go on that term. However, they're all heavily invested in that spot, and it's a long-term development play as well.
And how do the options work? So in medical, is it the same as a traditional lease? If I'm an investor, do they exercise their option 3 or 6 months out? Is there a market review? How does that work?
Yep. So all of these are actually phenomenal market reviews and lease structures, the greater of CPI or 4%, which is
That's annually, or is that at market? Is that at option exercise?
That's annually with open-ended market reviews for majority of them. Usually it does come down to the lease, of course, but usually it's anywhere between 3 and 9 months. Usually around 3 to 6 months is the renewal period. There'll be a number of options, maybe 2 times 5 year options for each tenant, and they'll continue to renew those if everything's going well.
Fantastic. And obviously medical is not just doctors and diagnostic testing. It also includes vets. And we have an incredible property in Glen Waverley. It's probably one of my favourite of the portfolio. Darren, Green Cross. What do we know about Green Cross?
Well, Green Cross are one of the leading veterinary clinic hospitals in Australia. That one is a new 8-year lease, which is fantastic. So you've got a long-term lease. We're expecting somewhere around sort of 5.5% to 6%. Certainly we think it'll be sub 6%. And of course, it's a great prime metro Melbourne location. So that one's going to be popular.
Glen Waverley is absolutely prime. It's just incredible. And obviously we do have assets in Launceston and Queensland. As I look around the grounds, there really is something for everyone. Coming back to Select, Geoff, tell me about, we've got Launceston, almost 1.2 million in income. It looks like an older building to me. Tell me more about that.
Some of those tenants, it's heavily weighted medical and healthcare in that building. Some of those tenants have been in there for quite some time.
And it's a refitted. It was an old maternity hospital that was completely refitted. So inside it's immaculate.
That's right. And with multi-tenant medical centers, the big thing there, the benefit there for the tenants is the integration amongst the tenants. Right? Yes. I think it's going to be around that circa 7% mark as well. It's a phenomenal asset, part of our Select portfolio, and there will no doubt be crossover amongst Launceston, Blacktown, Charlestown, and the other Select assets as well. And
so talk to me. Is the yield being varied by the location or the fact that there's multiple tenants? Does multiple tenants also affect the yield?
It's a bit of everything, I'd say. Multiple tenants, location, WALE, of course, regional versus
now, what's
metro.
WALE?
Weighted average lease expiry. I believe all of those.
So tell me what that means, just for our newer listeners. What does that actually mean?
Yeah, so weighted average lease expiry or WALE can be calculated either by the weight of the income or the weight of the actual building area. So, for example, if you have Blacktown, your anchor tenant PRP is on a 10-year lease, about 70% of the income. So there's a strong weight there towards a 10-year lease. Your other tenants are on 5s, which is about 30% of the building. So the average tenure, the weight of the average tenure works out to about 7.8 years. So when you have multi-tenants, it's just a calculation of a weighted average across the center.
And we talked about regional investments being at a softer yield than metro investments. Darren, tell me, for people who don't know where Maitland is, or don't know, where obviously I think we all know where Wollongong is, but tell me about Maitland.
Maitland's one of the main hubs in the Hunter Valley and has always been strong in terms of investor focus. Not far from Newcastle. Newcastle is obviously a major city in the Hunter. So, no, Maitland will be popular with investors for sure.
And obviously going up to Queensland, we've got also the QML pathology in Ipswich. And we also have an incredible property, Geoff, in North Lakes, which is brought to us by, partnered with CBRE, Nick Wedge, and together with Josh Capolan. Tell me about that.
That's an incredible asset. It's a freehold North Lakes, North Brisbane, phenomenal asset, main road. Your main tenant is UMC Medical, which is, of course, IPN. And, of course, IPN is owned by Sonic, so it's an ASX-listed subsidiary. So that should go very well. There's also a physio on site, ample parking, ample exposure, and good kind of heavy complementary particular precinct for medical and healthcare.
And North Lakes, especially in Brisbane, Brisbane land prices and values have been going up.
Great spot.
Incredible investor appetite in Brisbane as well. And then to be such a metro location, I think that will be one for the investors to really watch out for.
Definitely.
Tell me about wider influences within medical. Government funding is absolutely on the table. I know that next week the government is meeting with all their tax reforms and to talk about the future of tax reforms in Australia. But medical seems to be this constant funding that flows to it. Darren, what can we expect in the future from funding of medical?
Yeah, well, it's never going to go away, is it? It's a bit like childcare and a lot of these sectors where they're just going to have to continue to receive government funding. We've got an ageing population, as we've touched on. We're in a much more health conscious world now. So it's under the spotlight. And as I say, it's not going to go away. And then we've got NDIS and other parts to that as well. So no, government funding is going to continue and it's only going to increase in my view. What that's doing, it's dragging private investment into the sector as well, which is very important. And I think that's what investors like as well. And we've got a number of the major REITs, the trusts now investing in healthcare. And as I say, private investors have been doing it for a long time, but it's only really gathered momentum since COVID and coming out of COVID.
And I mean, Australian Unity, for example, comes to mind as an incredible owner of these sorts of investments. They're long-term REITs that have performed very, very well in the market. So now coming around then, talk to me about actual price. If I want to buy one of these things, so I know you said they come anywhere from 700,000 to 35 million, but what's driving price? Obviously it's income. What at the 5 million price point, the 2 million price point, the 7 million price point, what is there? What am I looking at?
Land area is key, of course. As Geoff touched on, infrastructure around you, and that's not only just medical infrastructure around you. In the case of Charlestown, we've got Charlestown Square directly opposite the Charlestown asset. Charlestown Square attracts something like 10 million visitors a year. And we talk about car parking. Well, there's major car parking across the road. Of course, our property has car parking, but hundreds and hundreds of car spaces across the road. So land area, key infrastructure around you, lease term, of course, number of tenants, all those factors, age of the building.
And there's also an incredible rise in the requirement and the demand for diagnostic testing. I know that there's now this, living forever kind of theories where people want to get extra blood tests and extra MRIs and extra testing. And then obviously there's always that constant need. So the customer flow to these spaces is only going to increase. So Geoff, we've talked about Charleston. What about Marsden Park? Tell me about that property.
Marsden Park's also a phenomenal asset. You've got Specsavers there. You've got El Jana. You've got the childcare amongst other retailers. Premium metro Western Sydney location, right on the main road. Beautifully designed asset. Multiple income streams, strong depreciation. It is brand new.
And it's a mix of everything then. So you've got a bit of medical, a bit of childcare.
Exactly. And there's really strong, large business parks around you as well. Your landlords are big institutional landlords, which are your neighbors. So that asset should go very well.
And what kind of income is that asset?
It's about 1.525 million net.
Wow. That's an incredible one. And what kind of price point do you think that one's going to be on a yield?
It's tough to say because it's quite a rare asset. Somewhere between, these metro high-performing assets, somewhere between 5.5, I'd say, for something like that.
But I mean, brand new, you've got to factor in your depreciation together with the interest rate cut from last week. It's going to stack up very, very well for an investor, for a long-term generational piece.
Really strong underlying land value. And then the cost to build. I think you probably pick that up close to replacement value when you look at the build cost versus land price, which is quite attractive for those sort of assets.
You touched on a really good thing there, Geoff, about cost to build. Coming back to these medical centres, I mean, we've talked about reinforced floors, we've talked about, lined walls, we've talked about these machines that are in them. I mean, can you even build these things these days?
It's tough. It's tough. Some owner-occupiers are buying land and building it themselves as well, but the cost of capital is quite strong. Obviously, cost of construction, cost of steel, cost of labor is very hard. So it's very hard to replace these assets. which is why buying them as an investor on the yield between, say, 5 and 6 or even 6 and 7 just makes sense, because you're actually purchasing the value of the real estate as well as if it was vacant. So that is quite attractive, these sort of
And
assets.
receiving an income immediately
Correct.
from some incredibly, high quality tenants
Exactly.
who you're going to be comfortable going to pay every month.
Yeah, exactly. The track record for these sort of tenants paying your rent, you're part of a system. You get paid monthly, and you don't really have to deal with the tenants. It's very much set and forget. All of these PRPs in our portfolio as well for the New South Wales properties are all net leases. So they are true net leases as well. Tenants pay all of your outgoings.
So Darren and Geoff, we've covered a lot about these medical properties today, but as investors who may or may not know about the medical industry, what they sell for, how to buy one, Darren, how do they find out more?
Well, one of the ways is through our sector-specific reports. So we're just about to release the upcoming medical report, which has information about yields, about entry points, about rents, construction, the special nuances of medical, which make it, so unique and so popular with investors. They're a great resource. A lot of work goes into them, and they're an easy read.
And Darren, where can I get this report?
On the website, the Burgess Rawson from CBRE website, or ask your agent to be able to get you a copy.
And Geoff, if I'm in WA and I want to know more about these things, how do I find out more?
Our portfolio magazines also have a lot of key information on each asset. All the agents, Burgess Rawson from CBRE, we all work together. We all have seen these assets, so we all understand the properties that we're marketing. Our magazine has a lot. The industry report has a lot as well. It goes into also a lot of good stats and growth stats as well, and where interest rates are sitting. So it's a good market knowledge and market intel. So it helps you price these assets that come to market. The reports are very great for that.
And you touched on a really important thing there, Geoff, is that our agents have seen these properties. So if I am in WA or I am in even New Zealand, I'm able to ring up and you can describe to me these properties. So you've seen the PRP medical portfolio. Darren, you've seen all the properties. So I think that first-hand advice is just so key to helping people, especially if they are interstate or overseas investors. That's right, Geoff?
Yeah, 100%. I think it's super important to see every property that you list. Whether you go in as a customer or even just drive to the car park and sit there for 10, 15 minutes, watch the flow of the actual building. Because when we're talking about these assets, yes, we are talking about the lease, but we're also talking about what's happening around it. For example, the hospitals next door, the traffic flow, the emergency sections, or the customers, or how it's integrated to the actual property next door. There's a lot of key features that you really need to understand, and you can't get that unless you actually go there yourself.
So 3 ways to find out more. Yep. Firstly is get a hold of our healthcare industry report. Great thought leadership and advice for people. Secondly, subscribe to Portfolio Magazine. And thirdly, call your expert agent, because they will be able to give you first-hand knowledge on the property. And we're going to finish off with our little game. If you could buy one property this portfolio, Geoff, what are you buying?
It's Blacktown, 100%. Blacktown is phenomenal, right next to the hospital. We talk about cost to build. I think it's going to be very similar in terms of cost to build versus what you're going to pay for that particular asset on the yield. Phenomenal backing with tenant covenants and just a really well done center.
And Darren, what are you buying?
I like Charlestown. It'll likely be a slightly better yield than Blacktown. It's a major regional centre. You've got great infrastructure around it. We touched on Charlestown Square. I like Charlestown, and close to Sydney, only a couple of hours up the road.
So you also, right with Charlestown, you're right beside the brand new Charlestown Health Hub, which is only opening now. So it's a $65 million cost build. You've got Ramsay, which is a private hospital. You have Nova Trials, which is a medical research lab. And you have IPN, which is Sonic Healthcare, GP practice. So there's going to be a lot of overflow from that center. That is a phenomenal center looking for obviously more space. Charlestown is your main health hub, like Darren said. That's
great names.
Going to go quite well. Yeah.
For me, I'm going the Glen Waverley vet. I can't help myself. I love animals. I think Glen Waverley from a land value, and I think there's a lot of value in Melbourne at the moment as well. And Green Cross is the tenant. I'm definitely I'm going the other way. I'm thinking about the dogs and the cats as distinct from the people. Well, thank you so much for joining me today, Darren and Geoff. I'm really excited about this portfolio, and I can't wait to talk about it next month and see what results came from it.
Thanks, Ingrid.
Thanks, Ingrid.
Thank you.